Most investors right now are staring directly at the biggest capital reallocation in modern history and positioning themselves on the wrong side of it. Not because they're uninformed, because they're looking at the right story through the wrong lens. The company's getting all the media coverage, all the social media attention, all the retail excitement. Those are not where the structural money is moving. The structural money is moving one layer deeper. And by the time that becomes obvious in prices, the opportunity will already be gone. I'm going to show you exactly where it's going. 8 specific pools of capital, the infrastructure beneath each one, and why the investors who understand this distinction are going to look back at 2026 as the clearest setup of their investing lives. If this kind of analysis is useful to you, hit the like button right now. It tells me to keep making it. Before I walk you through the 8 themes, I need to give you the single most important analytical framework in this entire video. Because without it, you can hear all 8 opportunities and still position yourself incorrectly in every single one of them. Here it is. Every major technological transition has 2 layers: the application layer, the products consumers use, the companies competing for market share, the names that end up on magazine covers, and the infrastructure layer, the physical systems, the processing capability, the energy, the security architecture that every application must use regardless of which ones win. The application layer is where retail attention goes. The infrastructure layer is where institutional capital goes. And the gap between those 2 things, that gap is the opportunity. The investors who built positions in semiconductor equipment in 2018, in network infrastructure in 2020, in grid construction in 2022, they weren't smarter than everyone else. They were looking at a different layer of the same story. That's the framework. Keep it in mind for everything that follows. Drop a comment below. Are you currently positioned in applications, infrastructure, or both? I'm genuinely curious where most people watching this are right now. The first and largest pool of capital is artificial intelligence infrastructure. And I want to be precise here because the most common retail approach to AI investing is wrong in a specific and costly way. Most investors are focused on AI applications, the chatbots, the generative models, the consumer products generating social media attention. This is the wrong layer. The application layer is intensely competitive, rapidly commoditizing, and characterized by genuinely uncertain monetization. Hundreds of companies are competing simultaneously. Nobody knows which ones win. The infrastructure layer is different. Every AI application, regardless of which ones ultimately dominate, must use the same compute, the same networking, the same power systems, the same data architecture, the same security stack. The companies supplying these layers grow with the build-out itself, not with the outcome of the competitive battles above them. The numbers confirm the direction. The AI market is generating roughly $300 billion in revenue this year. U.S. companies alone committed approximately $40 billion to AI infrastructure in the first quarter. The full-year capital commitment approaches $700 billion. That capital flows through the infrastructure stack. The companies in the irreplaceable layers of that stack are the structural winners, not because of which AI model wins, but because every model needs what they supply. The second theme is semiconductors, the physical foundation of all digital activity, not just AI. Every drone, every autonomous vehicle, every robot, every data center. The global semiconductor market is expected to reach $1 trillion in annual sales this year, a 25% increase from last year, driven almost entirely by AI demand. Half of all chips produced globally now go into AI applications. That's not a trend. That's a structural demand reorientation. But here's what most people covering semiconductors miss. And this is important. The real opportunity isn't in picking which chip company wins the next design cycle. It's in the moat structure of the companies that sit beneath all of them. ASML makes the extreme ultraviolet lithography machines required to produce the most advanced semiconductor nodes. There is no other company on the planet that builds these machines. ASML is a literal monopoly at the most critical choke point in global chip manufacturing. TSMC manufactures the chips those machines enable, similarly positioned at the frontier of advanced production. NVIDIA's CUDA software ecosystem is embedded so deeply in the global AI development workflow that competitive displacement would require years of re-engineering by thousands of organizations simultaneously. These are not advantages that erode in a quarter. They compound with every additional customer, every additional developer, every additional application built on their platforms. Share this video with someone who's been asking you about semiconductor investing. This is the distinction most people never hear explained clearly. The third opportunity is defense and autonomous systems. And the distinction I want to make here is the same one I made with AI. The traditional defense thesis: large established contractors, long government relationships, steady contract revenue, that's already priced into those valuations. That's not where the structural change is happening. The structural change is in autonomous systems, drone technology, AI-driven electronics, the specific technology layer that is reshaping what warfare actually looks like operationally. Ukraine plans to produce 7 million drones this year. These systems are now responsible for approximately 80% of battlefield damage in active conflicts. That's not a projection about the future of warfare. That is the current operational reality. And global defense budgets, which reached $2.6 trillion this year, are being reallocated toward this technology layer at a pace that creates a sustained, committed demand cycle. The fourth opportunity is cybersecurity. I know this one doesn't generate the same excitement as AI or drones, but the investment logic is the most mechanically predictable of all 8 themes. Every expansion of AI capability expands the attack surface of every organization using it. Every new connected device, every autonomous system, every cloud deployment creates new breach vectors. And quantum computing, which is advancing faster than most mainstream analysis acknowledges, threatens to render existing encryption standards obsolete within a decade. Every company, every government, every financial institution is spending more on cyber defense every year. Not because they want to, because the cost of not doing so is existential. This is not discretionary spending. It is compulsory infrastructure investment that grows with every expansion of the digital systems it protects. Now, here's where this gets more serious. Because the next 4 themes are the ones with the largest gap between institutional awareness and retail positioning. And the gap between those 2 things is exactly where the opportunity lives. The 5th theme is robotics and automation. The connection to the first 4 is direct. If AI is the intelligence layer and semiconductors are the processing layer, robotics is the physical manifestation of that intelligence in the real world. Every repetitive physical task in manufacturing, logistics, healthcare, and agriculture is now within the technical reach of robotic systems. The driver here is not consumer enthusiasm, it's corporate cost structure. Labor is expensive and becoming structurally more so. Automation delivers consistent, measurable, improving productivity at a cost curve that declines over time while labor costs move in the opposite direction. The companies supplying the mechanical systems, the sensors, the control software, and the specialized medical robotics this transition requires are operating in a demand environment that compounds for decades. The 6th opportunity is uranium and nuclear energy, and this is the one that most investors are still getting wrong. Not because the thesis is obscure, but because the narrative around nuclear power spent 30 years being defined by fear rather than physics. The physics never changed. Nuclear is the only energy source that delivers continuous, weather-independent, scalable, zero-carbon baseload power. What changed is who's demanding it. Microsoft has signed a nuclear power plant agreement. Google and Amazon are actively investing in small modular reactor deployments. The reason is straightforward. AI data centers cannot be reliably powered by intermittent renewable energy. The physics of continuous high-density compute demand requires continuous reliable power supply. Nuclear is the answer the AI economy arrived at independently, not through government mandate, not through ESG pressure, but through the basic operational requirements of the infrastructure it needs to run. Uranium demand is now growing at a pace the current production base cannot satisfy, because nobody built new uranium mines during the decades when nobody was building new nuclear reactors. That supply-demand imbalance is structural. It will take years to resolve. The capital committed to resolving it is already moving. The seventh opportunity is the space economy. This is the most frequently dismissed of the 8 themes, which is precisely what makes the gap between current valuation and long-term structural value potentially the largest. The global space economy is expected to reach $460 billion this year. But the investment thesis is not about exploration or tourism. It's about infrastructure, satellite communications, GPS positioning, Earth observation, and the global internet connectivity that low-orbit satellite networks are making available to every location on the planet, regardless of terrestrial infrastructure. Every government needs satellite reconnaissance and communication capabilities independent of ground-based vulnerabilities. Every logistics operation, every agricultural system, every emergency response network depends on the positioning and connectivity that satellite infrastructure provides. And the defense dimension of space, now formally recognized as a critical domain of national security, is adding committed government capital to the commercial demand already in motion. The eighth opportunity is U.S. industrial reshoring and infrastructure. This one sounds the least exciting. It carries perhaps the most certain near-term revenue visibility of all 8 themes. The United States government has committed over $1 trillion to rebuilding the electrical grid, modernizing transportation infrastructure, and incentivizing the return of manufacturing capacity offshored over the past 3 decades. Tariffs are making domestic production more economically competitive. Tax incentives are making new domestic manufacturing investment financially attractive. And the companies doing the physical work, grid construction contractors, engineering firms, industrial equipment suppliers, raw material producers, are sitting on contracted backlogs that provide revenue visibility regardless of the broader economic environment. Quanta Services, the largest grid infrastructure contractor in North America, is currently carrying a $44 billion backlog, 3 years of contracted revenue already on their books. The counterparties feeding that backlog are utility companies and government agencies operating under legally binding commitments. This is not speculative demand waiting to materialize. It is committed capital already flowing through a specific set of companies that have the technical capability to execute the work. Now here is the peak insight, the one that ties all 8 themes together and explains why the investors who captured the largest returns in each of these cycles did so while most of the market was still watching something else. The opportunity in every one of these 8 themes is not in picking the application winner. It's in identifying the infrastructure layer that every participant in the theme must use. In AI, that's compute, networking, power, and data infrastructure. In defense, it's the autonomous systems technology and electronic components every modern weapons platform requires. In the space economy, it's the satellite manufacturing and launch infrastructure every application depends on. In U.S. reshoring, it's the grid construction and engineering firms that every policy initiative requires someone to execute. The application winners are unknown. The infrastructure providers are knowable, because the demand for their specific products is structural, not contingent on which application wins above them. This is not a framework built on prediction. It's a framework built on certainty. The infrastructure gets used regardless of the outcome of the competitive battles above it. That asymmetry, knowable demand, uncertain application outcomes, is the single most important distinction in positioning for a multi-year structural move. The 8 opportunities I've described are not disconnected trends. They are expressions of the same underlying reality. A global economy being fundamentally restructured by the convergence of artificial intelligence, energy transition, geopolitical realignment, and industrial policy, and requiring a specific set of physical infrastructure, technical capability, and processing power to execute that restructuring. The capital flow data, the actual institutional movement into specific sectors and specific names, is visible to anyone watching the right indicators. The biggest investment opportunity of this decade is not a single stock. It is a framework, a systematic way of identifying where structural capital is flowing before it becomes obvious in prices. Building positions in the infrastructure providers before the application story captures all the attention, and maintaining the discipline to hold through the volatility that every multi-year structural move generates. The data is public. The flows are visible. The infrastructure map is clear. The only question, and it's the only one that actually matters, is whether you're positioned at the right layer. If this framework changed how you're thinking about these 8 themes, share it with one person who's been trying to figure out where to position in 2026. It genuinely helps. And if you want to go deeper on any of these 8 themes, the specific companies, the specific instruments, the specific indicators I track to know when institutional money is moving in or moving out, subscribe. I break this kind of analysis down every day, not to tell you what to buy, but to make sure you're watching the right layer of the right story.